I'm happy to say that Mr. Hakimian from Tolou Capital Management is joining me here today. Welcome, Mr. Hakimian. It's great to talk to you again.
Thank you so much, Elias. It's good to be back on.
Well, the economic data that was released so far this year has been quite strong. Inflation data has been quite strong as well. First of all, I would like to talk about the manufacturing PMI that was released recently, because sort of the whole debate a couple of months ago was whether the manufacturing sector will catch up to the service sector. And the manufacturing sector now seems to rebound. What do you think about this, and what are the implications for the Federal Reserve and monetary policy?
If you had asked me this question yesterday, the day before, my answer would be totally different. But so we got the manufacturing PMIs on Monday. We also got the services PMIs yesterday, which were the weakest since March of 2020 in the United States. So at risk of sounding silly, I think we just have to take these PMIs a little bit with a grain of salt. I mean, services PMIs being at March 2020 levels, it's just a little bit hard to believe. Given everything else we know about the economy, that's a little bit hard to believe. But yeah, I think if you want to speak about both the US and Chinese manufacturing PMIs, they've exited correction territory. They're in expansion territory now because they're above 50. And I think that just alludes to the fact that the economy is secularly strong. It's able to handle the level of interest that both nominally and in real terms, which is frankly surprising. I did not think that we would have a 2% real yield in April of 2024. I would have been the first one to tell you that I thought that a 5.25 Fed funds would have fixed the thing, but it appears that it hasn't yet. We still have 3 rate cuts priced into the outlook. I think that is at jeopardy, frankly speaking. If there were to be a continuation of this hot data, I don't see what would warrant cutting these rates. I mean, if payrolls are north of 200,000, when Chair Powell has said 100,000 is neutral, if core inflation is running somewhere between 3 and 4%, and real GDP is running close to 3%, I don't see any reason why we would have to cut rates going into this. But if we do, I believe there are interesting ways that asset markets will react, and you can take advantage of it. But I'll save that for later on in the podcast.
Absolutely. So what do you think about labor market data in general? How much of a significance does labor market data have in the reaction function of the Fed? And sort of to connect it with the recent data, what do you think about the recent ADP payrolls report and wage growth, especially?
So we're going to get another one tomorrow. So by the time this podcast comes out, these might sound like famous last words, but just speaking about the ones that we've seen so far in the year. So we've already got in January and February. It's hot. It's beaten every economist, or the median economist estimate. It's also beaten, again, I'll refer to Chair Powell has said that 100,000 net payrolls added per month is what they're essentially looking for as the neutral rate. That would be a rate where we're just replacing for retirees and accounting for population growth. And anything above that would suggest that the labor market is hotter than neutral, which would mean it would be stimulative, or there's net demand for employees. And we've been well above that. And I think this is one of the biggest reasons why the 10-year is up 50 basis points on the year. Because we are a services economy, it's a very linear and self-explanatory reason why people finance their spending via their jobs, via their incomes. If job destruction is occurring, less spending happens, which will mean less corporate profits, which will mean more layoffs, and it's a self-fulfilling cycle. And it works the other way too. If there's demand for labor, that means incomes will go up across the country, nominally at least, and with that income, people will spend, which will be more profit for corporations, which will allow them to expand via profits and via access to debt, because their credit, their availability to credit goes up as they get bigger due to their profit and due to their balance sheets. So it's, to me, the labor market has always been the most important thing, because nothing is more impactful to consumer spending than whether you have a job or not. And data strongly shows, and I think it's really showing it in the last couple of years, if you have a job, even if the Fed funds is 5.25, you'll keep spending, right? So, right, and then if you keep spending, it's a little bit difficult to get inflation sustainably down to 2%. But at the same time, it also bodes tremendously well for corporate profits, as we've been seeing and has been reflected in the equity market for sure.
Now, Mr. Powell has said that if we were to see a deterioration in labor market conditions, even if inflation still is above 2%, the Fed would be willing to cut. So I think that highlights the importance of labor market data for the Fed. But let's assume, let's say inflation stays at the current level. So PCE stays at the current level, headline CPI, all the metrics stay at the current level. But let's say wage growth comes down significantly until July, or payrolls come down to 100,000 until July. Do you think the Fed would be willing to cut just because labor markets have cooled, but inflation has remained at the current level?
Humbly, judging by what Chair Powell has said publicly and the FOMC has sort of telegraphed, I think they would cut. I also think that would possibly be a mistake, because if you're going to be cutting into if inflation is not changing and you're cutting into that, and payrolls are softening, you are risking stagflation, which is far and away the worst environment, both just for Main Street and for Wall Street. Any type of environment where inflation is either rising or sticky into falling jobs is horrible. And and I don't envy having that. I do not wish to have the job, but that would be very difficult, because on one end, like you said, you have those jobs that are collapsing and you want to offer some support to the economy, but on the other end, you have not solved inflation. And that's when people refer to, we were trying to avoid the 70s, inflation had cooled a little bit, they took their foot off the gas, and then it exploded higher. And then you needed a separate Fed chair, Chair Paul Volcker, to come and take quite drastic measures to fix that. So that's the last thing that I think we want. But I humbly believe that is what would happen in the event that payrolls were falling and inflation was sticky. I don't hope to see it, but it's definitely possible.
So do you think for Mr. Powell, a slowdown in labor market conditions, not a deterioration, would already give him enough confidence to cut, sort of from Powell's perspective?
He's explicitly said that a deterioration would, so we know that, assuming that he's going to stick to his word and doesn't change his mind, we know that much. A slowdown, I personally believe, warrants caution. And there's hawks on the Fed, not everyone's a dove on the Fed. So I'm sure that commentary is ringing in their ears when they're having their debates, and they release their minutes. It's very transparent. That's one of the best things about the Federal Reserve. It's one of the reasons I'm so interested in finance. I don't know of anything that's as consequential and at the same time as transparent as Federal Reserve meetings. When do you hear the debate in Apple's boardroom? You don't hear that, right?
Yeah.
So
yeah, you're absolutely right about that. Certainly always very interesting to watch the FOMC meetings and the press conference. Let's talk a little bit about the January and February inflation data. So I would like to know, what are the implications of that stronger inflation data for the Fed? And does the Fed sort of look at this from the perspective of, it wasn't expected bump in the journey back to 2% inflation? That's sort of, everyone expected.
We'll talk about Mr. Powell again. He was at Stanford University in California yesterday, and he was talking about the fact that in his opinion, nothing has materially changed his outlook based on these past 2 months of data. And I think he somewhat alluded to the fact that he believes it's a bump. And, to be fair, maybe it is a bump. So maybe we need more data. My opinion, though, is that given the fact that we want to be data dependent, right? What is the sense in telegraphing, a rate cut in December of 2024? We're in April, right? What is the benefit of that? Because, then current market prices for the 10-year yield, for the 2-year yield, for equity markets, for gold, for oil, for whatever it might be, for Bitcoin as an example, is priced based on that assumption. And that if that assumption does not end up happening, you end up having effects in asset markets, and it could that's what really creates volatility in the fixed income space. And I don't know why we would want to unnecessarily have volatility in the fixed income space. We're not at a point where inflation is 9% and the Fed fund is 0, right? Or 2, right? We're not like negative 700 basis points behind. I mean, is it sticky? Sure. But it's definitely manageable. We're not in like that crisis of the summer of 2022 right now. So I just I disagree humbly with the excessive telegraphing of forward guidance. I don't think it's necessary.
Yeah, absolutely. And I think this is a great opportunity to ask you about the loosening of financial conditions that we have seen since the Fed pivot. And I know Mr. Torsten Slok from Apollo often talked about that loosening caused a rebound in the labor market, and it had the stimulative effect on the US economy. What do you think, how great is the effect of the loosening in financial conditions that we have seen since the Fed pivot last year?
So, I mean, if we're going to talk broadly about financial conditions, no doubt they've loosened. I mean, look at equity markets, look at home prices, look at whatever you want to look at. But if you want to look at what I think is a little bit more important for the actual economy, as it transmits, into real activity, I think we should look probably more at the fixed income space. That's a lot more important. Companies, finance themselves usually via debt. It's quite rare post IPO for a company to finance its operations via issuing more equity. So if we look at the fixed income space, we had a peak 10-year of about 5. We got down to we had a 3 handle on it. Very quickly that happened. We had over 100 basis points of loosening in the 10-year yield pretty quickly. And now we've had a kick back up. So I think we started the year at 390. We're right around 440. Last time I checked my terminal, we were at 440. And so they loosened, and that no doubt helps economic activity. It's simple. I mean, we saw a wave of companies refinance bonds, issue more debt, and I think that is a clear signal that corporations thought that the 10-year of 390 in early January was a gift, and they ought to take advantage of it. That because as an example, if they thought that we were heading for 6 cuts in 2024, which I always thought was highly unlikely, but let's say if corporations did think that, why would they have went into the fixed income space and borrowed? They would have waited a couple more months so they could have borrowed even 100 basis points lower, right? So I think the fact that we had that wave of bond issuance in January and February was indicative of the fact that corporations were taking advantage of that softening. And at least until now, it looks like it was a prescient decision. I mean, rates are back up 50 basis points. And no doubt about it, I think 100% that loosening in fixed income from, let's call it November 1st until the 1st or 2nd week of January, that had profound effects on corporate activity and overall economic activity. And it's definitely one of the risks. It's definitely one of the risks that the economy is hotter than usual. I mean, it's always easier to talk about these things in hindsight, but respectfully, in my opinion, that just felt like something that was in real time a little bit easy to see, what was going to happen. I don't want to use the word easy. Nothing's easy, but it felt obvious as it was happening. It didn't feel like we needed a mea culpa about it a few years later or anything. So.
Yeah, you talked about how the markets were expecting 6 rate cuts at the beginning of this year. I mean, those have been priced out at some point this year. I think after the manufacturing PMI, they were even priced for less than 3. But
Yeah,
the pricing out of rate cuts, equities were still able to perform very well. So
absolutely.
at what point do you think higher treasury yields, especially higher treasury yields, really start to put downward pressure on equities? Because let's say 4.5% on the 10-year does not seem to be enough to put downward pressure on equities.
It's a great question. Um, it's um, it, it's a little bit hard to tell because there are so many different factors at play: corporate earnings, revisions to forecasts for the future, etc. I think that if this rise in rates was due to the fact that the economy looks strong, that is still an environment where it's okay for strong in real terms, not strong in like I'm strong, not just anomalies, real terms, like the economy is strong and that transmits to corporate profits, to equity earnings. I think that is the type of environment where the market appears to be tolerating that higher risk-free rate. But obviously, look, no doubt about it, this is going to weigh on activity, right? So much of commercial real estate, banks, so high yield borrowers, like so much of their sort of MO heading into 2024 was this was going to be a sort of a transition year. We're going to weather it out. It's a tough environment, but none of our loans are coming due until 25 and 26. And by then, the 10-year is going to be back to 295 and we'll be fine, right? That's where I think that we could have a big problem. Higher for longer, if it continues into 25, the second half of 25, even 20, however long it continues, the longer it continues, something eventually is going to break. At some point, we can't just extend out loans forever and pretend they're not in the. At some point, if it's too good to be true, at some point it has to stop. So I think that becomes the risk. I don't think it's an immediate risk. I think it's more of an intermediate term / medium term risk that if we stay higher for longer, this is going to have effects, especially on borrowers, especially on people that have to refinance loans, particularly on high yield or junk borrowers that they have a lot of debt coming due, and last time they refinanced it, the 10-year had a 1 handle, and now it might have a 4 handle on it. So that could really hurt balance sheets.
Absolutely. Let's talk a little bit about the risk of keeping rates at a higher level for longer. Now, Christopher Waller, for example, the governor of the Fed, he is, of course, pretty hawkish, but he has said that the risk of cutting too soon is still significantly greater than the risk of keeping rates at the current level for longer. And I would like to sort of connect this to the neutral rate of interest, because for me, the fact that the US economy remains so resilient, despite the fact that the federal funds rate is so high, is an indication that the neutral rate of interest is higher. But Mr. Powell yesterday in his speech has said the economy has remained so resilient because the supply side of the economy has improved. So it might not necessarily be an indication that R star is higher. So my first question is, how much higher is the risk of cutting than the risk of keeping rates at the current level for longer? How much higher is that risk? And for you personally, the longer the US economy remains resilient, is that an indication that R star is higher? And does that higher neutral rate of interest mean that the risk of cutting too soon significantly increases versus the risk of keeping rates higher for longer?
Okay, so we'll start with the first question, which was basically, is the risk of cutting greater than the risk of holding?
Yeah.
I believe yes. I believe, and maybe this is a different school of thought, but I personally believe that the last thing that we want as a society, as an economy, I believe that the Fed wants is for inflation to get entrenched and for these expectations to go up, Okay, as a good example, right now, consumer 5 to 10-year inflation expectations are falling. That's a University of Michigan survey that's done. That's falling. The market implied 5 to 10-year inflation, which we can call that the 5 to 10-year break even, right? The 10-year break even as an example. That's been steadily climbing in 2024. So that's interesting because consumers think inflation is going to go down, but consumers are very reactionary to changes in oil and gas prices. So if the price of the pump rises, their expectations rise. If the price falls, their expectation falls. The market has a little bit more of a holistic view. And I'm not saying one is right or one is wrong. I'm just saying there are two different ways of measuring it. The last thing that we can afford is an environment where inflation expectations, consumer inflation expectations start following market inflation expectations and start rising. Because if that happens, people demand higher wages. Companies in turn raise prices to protect their margins, right? That's how it works. And as much as they can. People on fixed income get crushed. And you end up having this wage price spiral that then you really require actions that we do not want to take monetarily as a society to fix it. That is how you end up, in a world where we have to raise the Fed funds again. And that's the last thing I think we want to do. So I personally believe that the risk of cutting right now is higher than the risk of not cutting. And then your second question was in relation to R star, the neutral Fed funds rate. Okay, so we'll talk about the Fed dot plot. They still see it at 2.5. Sorry, they said it's 2.6, but more or less, they still think R star is 2.5. If you look at the lowest Fed funds that the market is pricing in, so OIS swaps, the lowest Fed funds that the market is pricing in this cycle is 3.75. And Bill Dudley, who's the former Fed chair, he had a fantastic article on Bloomberg, an opinion piece, I should say, on Bloomberg about this. So that definitely implies that the market itself, right? Asset markets think R star is 125 basis points higher than what we thought it was before, which we thought it was 2.5. My take on this is Fed is too optimistic, and I think the market is too pessimistic. I personally believe that it's somewhere in the middle. Just consider this fact, okay? When we're talking about R star, over 50% of mortgages outstanding in the United States have an interest rate of sub 3%. All right, over 50% of mortgages outstanding are paying 3%. Right now, the spot price of a 30-year average mortgage is in the high sevens, low eights almost. What would have happened if we had a cycle that was a little bit more usual in the sense that we didn't have this massive refinancing wave before the rate hiking cycle began? And maybe, that is possibly one criticism that historians will have 20 years from now about that post-COVID time frame where we so clearly telegraphed when we were starting rate cuts, first by tapering QE, and then by doing that, and then by letting inflation run up to 6% before we started a single hike. If that didn't happen right now, there's no doubt in my mind the average mortgage rate would be a lot higher. Effective average mortgage rate would be higher for 5, maybe even, right? Because there wouldn't have been that massive refinancing wave if this wasn't so clearly telegraphed. And in the event that, the biggest way that, the Fed funds gets transmitted to the average person is through the mortgage, right? And that's the biggest debt that that's the most rate sensitive assets arguably in the world. what was the way it would have transmitted? Let's say we were in a world where the Fed average mortgage balance rate was 5.25, all right, instead of 3. There's no doubt in my mind personally that the economy would be slower, and I don't think we would be having these debates about R star being 3.75 rather than 2.5. I think we would be having a discussion. Okay, maybe R star is maybe 50 basis point, maybe it's 3, right? But I don't think we'd be talking 3.75. So in my personal opinion, I think that it's just too early to tell if R star has permanently moved higher. It just, things in economics don't suddenly shift like that out of nowhere. So I think we'll see. And there's going to be amazing studies that are going to be done starting now and going forward. And so we'll get more data and we'll make up our minds then. But at this point in time, I'm not sure if R star is permanently 125 basis points higher than it should have been, than it was before, I should say.
How significant do you think is it that the Federal Reserve changed its estimate to 2.6?
I don't think that's the most significant thing. There's a range. I mean, I'm sure that the most hawkish member of the FOMC probably has an R star that's north of 3. I mean, shoot, I'm forgetting which Fed member said it today. I want to say Mester, but I don't want to be wrong. But I believe it was not today, this week. But someone had said that they personally believe R star is 3.
Okay.
And I'm sure there's people that still believe it's 2.5. There's probably people that think it's under 2.5 if we have an average of 2.6, right? If we have someone saying 3, it means we probably have to have someone saying 2.1 if we're getting an average of 2.6, right? So we'll see. I think we'll see, but I don't think it's so significant yet.
Absolutely. Okay. Kathy, Liz Ann Saunders from Charles Schwab recently released a note saying that historically the Federal Reserve usually raises interest rates slowly and then cuts them quickly.
Yeah.
But in this cycle, it seems to be the other way around. The Fed raised rates very quickly, and now it seems like it will lower them slowly. I would like to ask you, what kind of cutting cycle do you expect from the Fed this year? When do you expect the first rate cut? And then, yeah, how will the Fed proceed from there?
So it was a great note by Liz Ann Saunders, as you said. And, for whoever hasn't read the note, basically, why does the Fed, hike very slowly, usually hike very slowly and then cut very quickly? Well, that's because a problem arises. A credit event happens, an exogenous shock like COVID, you have an Asian financial crime, whatever you might have, right? So what ends up happening is we have to cut very quickly at 2008 to 2020 to provide as much monetary stimulus as possible to avoid having a 8% contraction in GDP for a year. So that is what happens when we end up cutting the Fed funds to 0 very quickly, as an example, or to 1, or to whatever we do. Obviously, in this cycle, we have an inflation pressure, and we had to raise rates very quickly because we were very behind the ball. Like, we were really behind, and we had a negative real Fed funds rate. In relation to interest rates, so in relation to and now we got more into equilibrium, right? Why this cutting cycle is slow is because we have no economic issue. I mean, what's wrong? I mean, real GDP is growing at 3%. Like, why would you cut? What, like, why would you cut? Corporate profits are at record high, equity markets are at record highs, right? There doesn't seem to be any reason for now to cut. So yeah, I think right now we're going to take the stairs down in terms of interest rate cuts. Can that change? Absolutely. And how that can change is if we have a credit event, if we have some, regional banking crisis, or if we have, all of a sudden we have losses pile up or something, or there was some hidden risk in the market that it was just not foreseeable, and something happens, then yeah, then we'll probably cut a lot faster than is discounted into the market. But again, that's the whole point of being data dependent. I don't think we should assume that's going to happen, right? If it happens, and we'll cut. But to price that in to asset prices in advance, it just doesn't seem. It just seems like it's adding unnecessary volatility to treasuries, and that is the most important market for the world's economy, not just for our economy, for the world's economy. I don't think we should be doing things that are unnecessarily adding volatility to that space.
Absolutely. At the beginning of this cycle, so beginning of sort of in 2022, the Federal Reserve had said it will require pain to get inflation down to 2%. Now, obviously, we have not seen that pain, and inflation has still come down so much. And now the Federal Reserve is saying it will require time to get inflation back to 2%. What do you think is the effect or the idea behind that change in tone? And do you think this means that the Fed is not willing to cause economic weakness now to get inflation down to 2% because they are so much focused on orchestrating a soft landing because they have the chance now to orchestrate that soft landing?
Absolutely. I mean, so when Chair Powell was famously said it's going to require pain in 21 and 22, sorry, in 22 and 23, not in 21. We had inflation headline inflation peaked over 9%. And I think, I'm guessing here, but I think he personally thought the only way to get out of it was with a recession. And I don't think he'll ever say that. Maybe he'll write it in a book 20 years from now. But I personally believe I don't think he would have made such a comment unless he thought that the only way to avoid, to bring inflation back to target was with a recession. And that was the consensus view at the time. So he wasn't, it wasn't an anomaly for him to think that. It turned out to be a lot better. Supply-related issues, turned out to be transitory, or at least they were, they fixed. We had a surge in immigration, which helped to bring the labor market into better balance, not fully into balance, but into better balance. And we maintained it. So now I think they're trying to stick the landing, and there's no reason to to go crazy. Otherwise, I think we would be raising rates right now, right? So I think because it seems that the market can handle it, right? I don't think we can't handle rate high, but I don't think they want to do it because that re-increases the chances of causing pain. And if we can do this with time rather than with pain, I think that is their goal. I don't think they want to put millions of Americans out of jobs. Why? I mean, if we have inflation 100 basis points above target or whatever it is, that's not a crisis. That's a problem. But that's not a crisis. So I think that the approach of time is correct. I personally, if I was on the Fed, I would just keep the Fed funds here. I would definitely not cut, as we've said before, but I probably wouldn't raise either, unless something were to materially pick up, and unfortunately we might have to. Even in that case, I think you could maybe delay QT rather than delay the end of QT or the tapering of QT first, rather than raising the Fed funds. There's other ways that you can do things. So that's my personal opinion. I think it's a very wise approach that the Fed is taking here.
Yeah, it really seems like the Fed knows that they have this historic chance of landing the economy softly, and they really want to utilize that chance. As I already said before, the US economy remains very resilient. The data released so far has been very strong, and the economy continues to grow above trend. Now, we have talked about the fact that for the Fed, it is very important that labor market conditions continue to come into better balance. Do you think the fact that the US economy continues to grow above trend could cause the progress we have made in bringing balance back to the labor market to stall at this point, and hence keep wage growth pretty high at the current level as well?
No, because we have a record surge in immigration. Not a political statement in any way. I'm not a political person. Uh, uh, but that record surge in immigration, these are a ton of people that have joined the workforce. I think the Federal Reserve is even beginning to talk about it. Again, it's not a political statement, and I'm not commenting on immigration policy. I'm just saying the reality of what's occurred. And as that happens, I think that is one of the reasons why uh, wage growth has not significantly spiked, which is probably the best trend, I would say. Like a lot of things have gotten a little bit worse. Inflation, commodity prices, after that Fed pivot, a lot of things, that colloquial Fed pivot, I know they don't call it a Fed pivot, but and one thing that really, spendings even went up, but wages have just stayed consistently somewhere between, on an annualized basis, somewhere between 2.5% to 4%. So somewhere, high threes, low fours. And believe it or not, if we have productivity growth, wages growing in the high threes is actually that is a level at which you can have 2% stable inflation. It requires productivity growth that's well above average, but it wouldn't be the biggest outlier in the world if it happened. So I think that, and I don't see that, immigration surge stopping anytime soon. It's forecast that 2024 is going to even beat 2023 with the amount of new people in the workforce. And I think that helps a lot. That helps with retirements. That helps to balance out retirements. And I think that is one reason why I think the labor market it's not fully in balance, but it's getting close. It's getting close, and it can handle a hotter economy. If it wouldn't, wages would be up, I think.
Yeah, absolutely. That's correct. So you're to some extent betting on continued improvements in the supply side labor?
I think so. I personally think so. I personally think it's such a growth of people in the labor market, and it's continuing. If you just look at like the rate of the rate of people that are joining the market, the labor market, and how accurately can this all be tracked, right? To the best extent that it can be accurately tracked. It's massive. It's a multiple of other years. It's like 5 times what we used to get in one. It's like 5 years of immigration growth in a year, and they're all going to work at the end of the day. Like every single one of them, most of them, the prime age work, they're going to get a job, and that's going to fill. And those are jobs that are a little bit more on the lower end of the wage scale. That the most wage pressure was there, like restaurant jobs, and that was where the most wage pressure was coming out of COVID. These were jobs that you had to interact with people. There was hesitancy with the virus. There was a lot of people that became entrepreneurs or whatever it might have been, and it's probably the best thing that's happened to the Fed in terms of like a lucky roll of the dice. This is probably the best thing that's happened to them, I would say, in like 5 years. That they get the surge of people joining the workforce.
Yeah, I mean, as Mr. Powell said, that outside factor, improvements in the supply side of the economy, that has really done us a lot of good last year. It's incredible.
Explicitly used the word immigration yesterday at Stanford, and he strongly said this is not a political statement. He's not commenting on immigration policy or whatever. He just said that he's just reporting what he's seeing, and he's right.
Absolutely. And lastly, I would like to ask you about the tight high yield credit spreads that we're still seeing at the moment. And what is really the meaning behind it? Is it mostly simply due to the resilience of the US economy, or is it because we're seeing that significant increase in the supply of treasuries? Is it because of the risk sentiment on the market? Is it a mix of all of these factors? What do you think about the tight high yield credit spreads that we're seeing?
What's causing it is, like you said, it's probably a mix. It's probably the resilient economy is pushing, it's lowering default probabilities, and that's tightening spreads. It's also, it's a risk-taking conducive environment. You're seeing that in very frothy areas of the market are starting to, appear. Things are trading, not in line with historical valuations, etc. It's a risk. It's a big risk. If you ask me, it's a big risk. These are subprime borrowers, the subprime corporate borrowers. For years, they were borrowing at rates that are right now below the Fed funds rates, right? Like a high yield bond was yielding 4 in COVID, right? The Fed fund is 5.25 now. Just think about that. And I think two things that can make this go away. And for full disclosure, I have a short position on high yield debt at the moment. But two things that I think could catalyze it to make it go away. One would be if the economy turns, right? So much of a portfolio is always betting on an economy improving, right? People are systemically long almost everything, right? Unless they have credit, right? So they're long equities, they're long private equity, they're long private credit, they're long oil. The economy has to improve for these things to go up in value. So I think if the economy were to turn, high yield spreads aren't going to stay at 125 or 150 basis points. Right now, high yield spreads, the spread between a high yield bond yield and an investment grade bond yield is the tightest it's been literally maybe in history. Just think about that. I mean, are the odds of a recession right now the lowest they've ever been in history? I think the odds of recession are low, but that's not to say that they're zero. They exist. There's ways we can have a recession. We can always have a recession. So I think that in the event that economic activity weakens, that spread's going to widen out to 3, 4, maybe even 500 basis points, depending on how severe a recession would be. And then another thing that I think could move out, push up high yield spreads is in 25 and in 26, when they have to start refinancing debt, you're going to get a wave of supply, right? And as you get a wave of supply, in general, push up yield a little. So I think that there's two potential paths for what could cause, the high yield spreads to rise. I'm betting on it. We'll see. It's not a big position. It's just it's a hedging instrument. And I guess we'll see. But I don't think a high yield spread of 125 is so sustainable for a long time.
Absolutely. We live in special times. But it's very interesting. Mr. Hakimian, thank you very much for your fantastic insights. Once again, it's always great to talk to you and have a conversation about economics and the markets. And yeah, let's do this again soon.
I'm looking forward to it next time, Elias. Thank you.
Perfect.